Hello, this is Will Allen with Centera Capital. The last week has had no shortage of breaking financial headlines. We're going to tell you today what you need to know about Silicon Valley Bank, the Federal Reserve and their plan for interest rates, and the latest inflation reports. Let's dive in. What a difference a week makes. If we go back just 7 days, Fed Chair Jerome Powell was in front of Congress giving his biannual testimony. And he was talking about the fact that the economy has remained really strong over the last year, even as the Fed has been hiking interest rates. And that while inflation has been coming down, they would like to see it come down faster. And in order to get that happening, they felt they were going to need to raise interest rates even higher and faster than they had previously indicated. The fact is, if we take a look at the economic data that's been released over the last couple of months, no doubt the economy has remained really strong, and it starts in the jobs market. Over the last 2 months, over 800,000 new jobs created. And in fact, take a look at this chart. This compares the amount of job openings out there to how many people are unemployed and actively looking for work. And you can see there's 11 million job openings. There's only 5.7 million people actively looking for work. Fed Chair Powell has said he wants this to flip. He wants job openings to come down. He thinks that's necessary to bring down wage inflation. If we also take a look at the Atlanta Fed, they have something called GDP Now, which tracks all the economic data and estimates where the economic growth is going to come out for the current quarter. And you can see for the most recent quarter, they're estimating 3.2%. That would be in line with the last 6 months of last year, where GDP growth was around 3%. And so last week, Fed Chair Powell was talking about the fact that they may have to take interest rates up higher in order to cool off the economy. Well, all of a sudden, the Silicon Valley Bank failure late last week has thrown pretty much everything upside down, because a lot of smaller banks across the country, they provide about a third of credit to U.S. businesses and consumers. And what this incident's going to do is cause all the banks pretty much to pull back right now on lending, to make their lending standards a lot tighter, okay? So that is going to slow the economy, which is what the Fed wanted, and they were having a hard time getting that to actually take place. Now, what we also have seen in the last 2 days that we want to bring up are the most recent inflation data. And first up, you can see the Consumer Price Index, the CPI. And you can see this came in at 6% year over year, down from a peak of 9% last year. So it's coming down, not as fast as the Fed wants it to come down, but it is going in the right direction. Then the most recent data that we got yesterday, the Producer Price Index. You can see here, this is the PPI. So these are costs that businesses, wholesale cost is what this is. And you can see a significant decline here from a peak last year of 11.6. This came in at 4.58, much lower than what forecasters were expecting. All right, so between these two data, this gives the Fed cover next week when they meet. They have been planning on hiking interest rates. This gives them cover to either only hike by 0.25% or maybe to not hike at all, given the recent developments around the regional banks. Now, if you want one chart that illustrates best what has happened over the last week and how night and day the difference between last Wednesday and today, look at this chart. This shows what the market is projecting as far as the Fed's overnight interest rate by the end of this year, December 2023. And you can see on March 8th there, it was over 5.5% for the Fed interest rate. It is currently today at 4.5%, by the way. So you can see that In 1 week, it's dropped from 5.5 down to 3.64. This is the markets telling you that they expect that the Fed is going to be cutting interest rates in the back half of this year. That is a much, much different outlook than 1 week ago when the market was projecting that the Fed would have to hike interest rates 3 more times. Now, how this relates to your your portfolios is that if we take a look over the last 5 days, because interest rates have been coming down, that means bond prices have been going up. So in individual treasury bonds or in bond funds, those prices have been going up. You've made money. That's much different than last year. If you recall in 2022, what made that year so difficult is that when stocks fell last year, or you were having a significant sell-off, bond prices were falling also. They were not helping to cushion the fall. Well, that has not been the case in this occasion. And if interest rates go lower in the back half of the year, like the market thinks is going to happen, that means bonds are going to be a very good value, and they are going to help cushion any decline on the stock side. So the bottom line is if you take a look at what's been happening over the last week, we never like to see chaos with the banking system. But the fact is that if we see a slowdown in the economy, that may be good news in that what was happening prior was that the Fed was taking interest rates higher and higher because they were not getting the slowdown they wanted. And we were set up, the higher they went with rates, to have an even bigger problem on the other side with the banking system if interest rates reached 5.5 or 6%. So this could be good news in the long run. But we will keep watching over the coming weeks and keep communicating and taking care of your portfolios. Thanks and have a good day.